to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
Welcome to another episode of On My Way to Wealth. My name is Luis Rosa, and I'm your host. Today, I want to talk about cashing out of either a 401k or an IRA. A lot of us, unfortunately, have been impacted by COVID-19 one way or the other. So there's a lot of people out there who need money because they lost their job or their spouse lost their job or reduced income, and they just need to access some cash in the meantime. So I want to talk to you about the option of taking some money out of your retirement accounts. The first thing I want to do is talk a little bit about the new rules, because a lot of things under the CARES Act have been loosened up, a lot of the rules, so that it's easier and less painful to take money out. Second thing is who's eligible for it. And the third thing, is it a good idea? Just because you can do it, perhaps doesn't mean that you should do it. But I want to explore the options so that if you have to go that route, at least you make an informed decision and make it in the most tax advantageous way for yourself. So let's dive right in. The CARES Act was put into place specifically to help people suffering from economic impact from COVID-19. And that includes a broad range of measures. But I want to focus today specifically on how it's helping withdrawals for 401k and IRA distributions. So the first thing you need to know is typically, if somebody's under the age of 59 and a half and they take money out of a retirement account, they are typically subject to income tax plus an additional 10% penalty on top of that. So if somebody took out, say, $10,000, they would pay 10% penalty, so that'd be $1,000 plus income tax at their tax bracket, as if they were having ordinary income, basically. Now, the new rules under the CARES Act, if you have been impacted by COVID-19, are waiving that 10% penalty. Now, this is something I want to emphasize because sometimes you might read an article, see it out there where it says, hey, if you've been impacted by COVID-19, you can take money out of your retirement accounts penalty-free. And that is true, but it doesn't mean that it's consequence-free, because there are other things to consider, which we're going to dive into today. The first thing is the income tax situation. Even though the 10% penalty will be waived if you qualify, if it's a qualified distribution, which I'll tell you what those are, you still have to pay taxes on it. Now, there are different ways in which you can pay taxes on it. One, you can choose to pay taxes this year in 2020. The other way you can do it is you can spread the taxes over a 3-year period, tax years 2020, 2021, and 2022. So you can soften the blow, if you will, of having to dip into your retirement accounts to do so. Right now, you can borrow up to $100,000. In the case of a 401k, 50% of your vested balance in your account. The vested balance is the balance that includes your own contributions plus your employer's contributions that you're allowed to take with you if you left the job. A lot of employers usually give you some sort of schedule, a minimum amount of time that you have to be there. So when you look at your statement, sometimes the actual balance and the vested balance might be different. So make sure you look at your vested balance. So this is great, right? To some degree, because there are some people who will probably have no other choice but to do this, right? So having that option is definitely a good thing, but I want people to consider everything else as a financial planner and leave this as one of the last resorts that you dip into it. And here are some of the reasons. Number one, the tax implication of it. You have to pay taxes on this, whether you choose to pay for it this year or spread it over a 3-year period. If you lost your job and you're going to be in a lower tax bracket than usual this year, it might make sense to just pay all the taxes today, 2020, and that's it. But now, if you rebounded and you got your job back, you're back making money, you might want to soften that blow and spread it over a 3-year period. And this is something that your CPA or financial planner can help you decide. The second thing to consider is when you take money out of your 401k or IRA, most likely you had that money invested in the stock market. And if you did, it is very likely that as of the recording of this episode, you are probably still down in value from the beginning of the year because the stock market went down significantly, even though it has come up and down here and there throughout the year. But most likely, you are going to be then selling an already depleted asset. And that is a big problem because you're selling at the worst possible time. You always hear where you want to buy low and sell high. Where here you will be doing the complete opposite. Your assets are depleted, and now on top of that, to add insult to injury, you're going to be selling them at a low price. And then on top of that, you're going to be paying income taxes, which is really a double whammy. Here's the third thing that a lot of people don't realize. It's the fact that compounding interest is your friend. And over time, that money that you would have left there is going to accumulate and grow, right? So let me give you this example. Let's say you happen to be 40 years old and your plan is to retire at 65. So you have a 25-year period. If you have an $80,000 balance in your 401k, and we're going to, for simplicity purposes, not add anything to it, just so that you see the difference. If you have $80,000 sitting in a 401k, and let's say you get a 6% rate of return, so I'm going to go conservative somewhat or moderate, let's say, over a 25-year period, that $80,000 would grow to just over $343,000. That's just sitting by itself for 25 years at 6% rate of return without you adding to it, right? So that's $343,000. Now, let's say today you had that $80,000 and you say, you know what? I've been impacted by COVID-19. I need to take out $10,000 from my 401k. All right, let's see what the long-term impact on that is. Well, now you only have $70,000 left in that 401k. And let's say the same scenario. You're 40 years old, you're going to retire at 65. We're going to let this 70,000 sit there at 6% over that 25-year period without you adding anything to it. That same 70,000 would now grow to just about $300,000. Now, if you remember, the 80,000 would have grown to $343,000. So that means that taking $10,000 out today would have cost you $43,000 in the future of assets that you would have available in your 401k. So think about it this way. You have to touch your 401k or IRA. You're going to have a tax consideration, even though there's no 10% penalty. You are likely selling an asset that has already been depleted because the stock market is down overall. And number three, you're taking away money that would have compounded over the time frame that you were going to leave it in there. Right. So this is three negative things, which is why I always tell people as a financial planner, let's look at your other options first. Let's look at your emergency savings. Maybe even a Roth IRA, if you have one, might be a better option to tap into than your 401k or IRA. Now, obviously, I'd rather you not have to touch into your retirement savings, but sometimes if you've explored every other option and that's what you need to do because that's it, like maybe you took advantage of student loan deferments or mortgage deferment or your landlord maybe gave you a break here or there, but if you are going to avoid a major catastrophe in your life as a result, then you need to do what you need to do. And I understand that. But I just want you to make a conscious choice and make one that is the least damaging to you now, tax-wise, and also in your future. Now, let's talk about who's eligible real quick. How are you eligible for this COVID-19 related distribution, coronavirus related distribution? Well, you have to be quarantined, furloughed, or laid off. Now, when I say quarantine, meaning that you physically can't go to your job, but also it means that you can't get an income as part of that quarantine. Because if you happen to be quarantined at home, but you are working and you haven't lost your job, then it doesn't matter. Like you're still getting paid. So that in and of itself wouldn't be considered eligible. However, let's say you are married and your spouse loses their job and you're still home, working from home, making money, and nothing's changed for you personally, you still could take money out of your IRA or 401k because your spouse or a dependent has been diagnosed with COVID-19 or lost their job, like your spouse lost their job. That is considered a COVID-19 related distribution. So it's pretty broad in that sense. Also, having your hours cut. I have a lot of clients, unfortunately, who still have their job, but they have been reduced in their pay. 75, 70% of their pay, probably some for quite a bit of time, perhaps until the end of the year at least. That qualifies. If you have, let's say you didn't even get the job, you had a job offer and that job offer got rescinded or delayed because of COVID-19, that would help you as well. You would qualify. And even if you're self-employed, if you have your own business, let's say even if you drove like an app-based job, let's say you had like Uber or something like that, and you have a solo 401k or an IRA, and you can't perform your job because of COVID-19, that'll make you qualify as well. So you can take advantage of the provision that says that you don't have to pay the 10% penalty. Also, pay the taxes over a 3-year period. And the other thing too is that you have 3 years to pay it back as well. So not all hope is lost. If you happen to get back on your feet, which hopefully you will, you typically, when you take money out of a retirement account, you only have 60 days to roll that over. The IRS recently announced that now you have until August 31st for some people who might have already taken out, say, like the required minimum distributions for those that are over age 70 and a half that were already taking money out. You can change your mind and put that money back because some people don't need it and they were forced to take it because of the rules that were in place, which is another issue, right? So if you have, say you that are listening yourself, if you are already taking required minimum distributions and you already took it this year and you don't need it, you can put it back. That helps because it lowers your taxable income. And also you were selling a depleted asset, like I was saying before. Or if maybe one of your parents, talk to them. If they have IRAs or 401ks and they're currently taking requirement minimum distributions and they don't need it, some people are in that situation, which is great. Then talk to them about rolling it back in. So let me get back to the 60-day rule. Typically, once every 12-month period, you have the ability to put money back that you took out of a retirement account in order to avoid the tax consequences from having done so. So now under a coronavirus-related distribution, you have a 3-year period where you can put that money back. So your options are pay taxes in 2020, pay taxes over 2020, 2021, and 2022, or put the money back within those 3 years and not have any tax consequence. Now, what you do then is you would have already paid the taxes on your income tax return. If you happen to put the money back or a portion thereof, you have to go back and amend that tax return to let the IRS know that, hey, I put this money back, so I overpaid my taxes, and now I'm requesting a refund of those monies. So you got to talk to your CPA about that to make sure you file the proper forms. Usually on the federal side is the 1040X, which the IRS recently announced that it will allow this summer, starting this summer, that you file electronically, which is great. Because as of now, you can only mail in a 1040X, and the IRS is backlogged and understaffed, and amended returns have been taking quite a bit. But the fact that they're making it electronic is a big step forward that I'm very happy to announce. Hopefully, by the time this episode is out, they're already starting to do that. Another reason that you can qualify is if you're unable to go to work because of a lack of childcare. I also have clients in this boat where they physically are okay. Thankfully, their jobs are there and saying, hey, can you come back to work? And they're like, unfortunately not, because my typical childcare place is closed due to COVID-19 and I have nobody to leave my kids with, so I cannot go to work. That qualifies you for this coronavirus-related distribution. So let's say that's the case. You get your job back, but you can't go back because of lack of childcare. Well, that qualifies you, and you can tap into your retirement accounts and take advantage of the 10% waiver and also the ability to pay the taxes over a 3-year period or put it back over 3 years, which is great. Now, let me talk to you a little bit about 401k distributions versus a 401k loan, because sometimes people might not be aware of the slight differences. So the limits will be the same, where with the 401k loan, typically you were only able to get up to 50% of your vested balance or 50,000. They raised that limit to 100,000 or 100% of your vested balance. Now, here's what happens. If you take, say, a 401k distribution, you're not required to pay it back. All you have to do is pay the taxes on it. And you can choose to do that 1 year or 3 years. And you can choose to put it back, but you don't have to. Now, if you take a 401k loan, you are expected to pay that money back. You could delay the payment for a year, then you have 5 years to pay it. But here's something that some people may not realize. And I actually had one client that this happened to. They took a 401k loan and then they lost their job after the loan was taken. Unfortunately, what that does is you now have a certain amount of period till mid-October of next year to pay all of that loan back. And if you don't, that taxable becomes a taxable event. So when you take a 401k loan, it does not trigger any taxation. You just have to pay money back through your payroll, right, through your paycheck. And as long as you pay within the 5-year term, you're okay. If you take longer than 5 years, then that money becomes taxable. But if you take a coronavirus-related distribution, say a 401k loan instead, you start paying it back, it's fine, no taxation is triggered. Then unfortunately, you lose your job. Well, now you have to repay that loan back. And if you don't, it becomes taxable. And unfortunately, the additional 10% penalty does kick in. So you want to make sure you weigh those options as well between the 401k loan and the 401k distribution, because there are some differences that might be key for you to make that decision. So before you consider that route, I want you to explore any other option that you might have available to you, like your emergency savings and maybe even a Roth IRA. Because with the Roth IRA, you put pre-tax money into it. So if you have to tap into it, you might be able to take some of your own money back without having to trigger any taxation. Just something to consider. Obviously, I'd rather you not have to go that route at all. But like I was saying before, sometimes you explore every other option and you need to keep food on the table and keep a roof over your head. Then you got to do what you got to do, without a doubt. So be mindful of the fact that you have to sell the investment at a bad time. So that's going to be something that's going to really negatively impact you because now you're selling low. Be mindful of the taxes. So although there's no 10% penalty, you do have income taxes on it. So you have to pay that either in 2020, spread it over a 3-year period, 2020, 21, and 22 tax years, or put the money back if you can. And then you have to go back and amend those tax returns for the years that you made the contribution back. So a little complicated, right? And so that's pretty much it. Finally, the long-term impact of you taking that money out as well. The fact that you're going to be missing out on the compound interest over those years. So in my example earlier, taking out $10,000 for somebody that was age 40 and was going to retire 65, we're talking 25 years, and I use 6% rate of return just for example purposes, that cost them $43,000. So imagine if you take more out, or if you're younger, right? And say you're 30 and you're not retiring to 65, you're talking 35 years of compound interest. So it could have a significant impact. So if you need to, go ahead and do it, but see how you can figure out how to put that back, especially now that you'll have 3 years to do so, right? So this is why I always try to hammer into people the importance of having an emergency savings, because before COVID-19, it wasn't that clear as to why somebody would have, say, like 6 months worth of expenses in a savings account when they could be using that money to pay credit cards and all kinds of other stuff, which makes sense to some degree. But I feel like now that we've seen so many people lose their jobs or go home on reduced pay, you see how important it is for you to have that emergency savings. And it doesn't mean that it has to be 6 months worth of your income. It's just 6 months of expenses. Your most basic needs to keep food on the table, roof over your head, and pay the minimum and everything, right? So it's not like you need to have half of your income. It's just 6 months worth of expenses. So it's not the same. If you had to sit down and go to the very basic, because a lot of the things that you spend money on right now, you wouldn't if you weren't employed. Like 401k contributions, you will stop those as well, right? So just think about that for a second. Very important for you to take that into account. So thank you all for listening. If you have any questions, feel free to send me an email at luis@onmywaytowealth.com. The episodes are coming out once a week on every Wednesday. And so is a blog post if you want to read about it instead of listening to it. you feel free to go to onmywaytowealth.com. I have the podcast and the blog come out at the same time. Thank you for listening. I hope you stay well. If you have any questions, feel free to reach out. If you have anyone that you know that would be a good person to interview, or just questions in general, if you have a topic that you want to suggest for next podcast, I already have gotten in several that I'm already working on for future episodes. So thank you all those who have given me some feedback. I hope you stay well, and I'll see you on the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.